Hello everyone. In this video, what I want to talk about is the one thing that moves the markets, and that's liquidity. Now, liquidity usually occurs at turns. So if you were eyeballing this market with me now, you would simply have to look at previous areas where the market turned, and that would give you an idea where there's liquidity. So let's mark this chart up. So you can see on my chart there, I've just put these blue boxes on the areas where I would think, by eyeball, there is liquidity. And if I then ask myself the question, what is this market currently doing? Well, it's trading from this area of liquidity and it's trading away from this area of liquidity. So the market's doing either one of two things. It's either trading and creating liquidity, we call that internal liquidity, or it's searching for external liquidity. This is an area where it's previously traded before and it's found liquidity. And you can see that we've got this area here that I would have expected there to be liquidity, but the market didn't stop. So obviously there's not enough liquidity at this point here to actually turn this market around. So we've got this level, which is this large daily spike. Now, usually markets will head towards areas of liquidity. Think of it like a scale. So the market makers have actually accumulated enough orders up here, and now they're selling those orders into the market. So of course you've got buyers who are stepping in thinking that this market's still going up. They're buying this market and they're supporting the dealers that are selling into the market. So the dealers have much more money than you or I as retail traders, and they're the guys that are pushing the markets. So what are they actually doing here? Well, they're searching for enough liquidity so they can balance those orders up there where they sold, possibly even at this area here where they've sold, and now they're filling those orders where they were selling, so they've got to sell to people who are prepared to buy off them. And this is why this market is moving down to these areas of liquidity. So the thing is, what we've got now is we've got the larger time frame direction. We know this market's falling and we know that it's searching for liquidity. So what I'm going to do is I'm going to put on the liquidity map. This is an indicator that actually shows you areas of liquidity, and we can see what sort of a job I've done, because I've done this by eye. You can do this by eye, but if you've got an indicator, it will show you where the areas of liquidity are. And this is a liquidity map, and it's very good at picking up liquidity areas. So we've got a couple of settings that we can use on this indicator to help. First of all, we've got the time frame. Now, what that means is that we can pick either the time frame that it's currently on, or we can pick the higher time frame, such as a daily chart if we were, say, on a 4-hour chart, or if we were trading on the 1-hour chart, we could pick the 4-hour chart to show us where liquidity is. We want to always look for the higher time frame liquidity because we want to catch the larger moves. Now, the other thing we've got is we've got show calculations, and this is really important because when I put that to true, what I can see is actually a numerical value of the amount of liquidity that's sitting at a particular area. Now, if you're a little bit dyslexic like me, this is a bit of a nightmare. So this is why we colored the map candles. So you can see that the liquidity forming is actually indicated by a colored candle. And of course, the color of the candle dictates how much liquidity is there. The next thing we've got is sensitivity. So the indicator has different degrees of sensitivity, low, high, and detail. And I always set mine to high sensitivity. So with that said, we can now put that indicator onto the chart and we can see what it shows us. Well, as you expect, because I've been at this a bit of time, I'm not too bad at finding areas of liquidity. And you can see these dark colors of liquidity here on the daily, indicating that there's a lot of orders being transacted at that level. And the only people that transact a large volume of orders are the market makers and the banks. And these are the guys whose coattails that we want to grab onto, because we as retail traders are not going to turn the market. So this is why we need to get in where the banks are trading, It's quite simple. We want to trade on their coattails. So when these guys push the market about, we're riding with them rather than against them. What I'm going to do now is I'm going to go in to those areas of liquidity, and I'm just going to have a quick evaluation of how much liquidity was being generated. Now what I'm going to use is I'm going to use the top candles and the candle just before. So I'm just going to use the three candles as we formed a top. So here, for instance, I use those candles. Here I use those three. There I use those three. So what I'm looking at is how much liquidity was actually being generated at those levels. So what I've done is I've changed the calculation to show the calculation on the chart. So we'll be actually able to see the amount of liquidity that's being generated in those colored candles. And I put the font size to 12. That might not be big enough, but let's have a look. So just click OK. And you can see it's very busy on that chart. So let's have a look closely at, say, this area, for example, and we can see how much liquidity is actually generated there. So I'm just using the top three candles in that turn, and I've just added them up there in the Excel spreadsheet. You can see we get a liquidity value of 24,550. That liquidity value had the ability to actually turn that market down. So the next question I would have is, at this level here, what sort of liquidity did we have in those three lower candles? Let's have a calculation. Remember, I'm just using the candles either side of the turn, and we can see that in this lower level we had a liquidity value of 13,579. Now that turned the market, but there was more liquidity up here than there was down here. So if that was truly balanced, and I know I haven't looked at the liquidity that was formed in each of the candles going up, only at the turn candles, it means that there's still liquidity to be had on the upside, because there was 25,000 units of liquidity up here and only 13,000 units of liquidity approximately were generated down there. So that would mean that you would expect this market to be going up just on the bar count. Now let's go over now to where we are currently in the market, and we're going to do a couple of calculations because we want to know how much liquidity was sitting up here, how much liquidity was sitting up here, because once we see that figure rising rapidly, and we want to see a value of about 16,000 to 24,000 in terms of liquidity, then we know that this market's likely to reverse to the upside. So let's have a quick calculation again. So what I decided to do was actually put the liquidity values in the turn, just using the top three candles. So I'm not using all of the liquidity there, just the turning candles. And this is a very rough approximation, but you can see that we started off with 24,000. We absorbed 13,000 units of liquidity there, but that meant there was still about 11,000 units roughly of liquidity. Hence that market had to go back to get that extra liquidity. Now when we get up to that point there, we take out 3,000 roughly units of liquidity. So if we had 11 going up here and we take out 3, we've got about 7,000 units of liquidity. Now the reason these markets are moving up and down is because they're looking for liquidity. So once you exhaust the liquidity up at these levels, and you can see here liquidity dropped from 25,000 to 3,000 to 300 to 96, and that's why the market didn't want to stay up there, because there was no liquidity. So now you can see on this last bar we've got 12,125, which is a very high level of liquidity, and that means if the market's generating that sort of level of liquidity, then it's likely that the market is going to reverse. So as I said, we've only got one bar there, and that's already 12,000. So I would expect this market to be looking for a reversal because of the level of liquidity that's being generated in this single bar. So the next question to ask ourselves is, where is the largest level of liquidity? Because it's likely, if it's got 12,000 units of liquidity there, and we take out the bottom of that spike wick, that's got 9,000 units of liquidity. So 9 and 12 is 21. And that means that according to my spreadsheet, let's get that up, we only need between 13,000 and 24,000 units of liquidity, and it's likely that we get a reversal. So if that's the case, it means that this area is unlikely to be exceeded by very much, because in effect there's so much liquidity already here that the market is likely to react at this level. Now, I don't know in this candle where the maximum amount of liquidity is sitting at this level. Might be at the low, might be in the middle, and you don't know. But what you do know is that coming into this area here, and what I'm going to do is just pull this box out like this, that we should be careful, because it's likely that liquidity is high enough here that we could get a reversal. So let's take the numbers off the chart and let's do some more digging into a lower time frame. So we know two things about this market. The first thing we know is that you need between 13,000 and 25,000 units to actually turn this market around, because that's what we have seen previously. Now, we know that that's a high level of liquidity, and we should expect that sort of level of liquidity to actually reverse this market. Now, this current bar that we've got on our right hand side, this blue one here, is already 12,700 units of liquidity. We know that this bar has 9,000 units of liquidity. So if we can find the level in this bar, we can find a very good trading area. So the way you have to think about this is basically what you're looking for is you're looking for an area of liquidity. So if that block represented liquidity, and we make it solid, you want to be wary of trading into an area of liquidity, because liquidity is associated with a turn, and if you get a large amount of liquidity, you run the possibility that you will get a turn. So in that area of liquidity, what we're looking for is we're looking for fair value. So if we can find the fair value level in that block of liquidity, that's likely to be the area where this market will turn around. So I'll put that in fair value. And what we've done is we've created an indicator which will actually tell you on each time frame you look at where fair value is. If you've got a block of liquidity, that's where you want to be trading, and you want to be trading at the value of fair value within that block of liquidity. So if I wanted to take a buy trade, I want to find the fair value levels in this area of liquidity, because they're likely to be reversal points. So this is the indicator, Quantum Trader's Ultimate Trend. And what I'm going to do is I'm not going to put a value in here. I'm going to keep that 0. Now, I do that because the indicator will draw lines at points where it finds fair value. But I am only interested in the fair value that's generated in a liquidity area. I'm not interested in the rest of the chart, only where there is liquidity. So liquidity 1, fair value 2. Those are the two things I'm looking for. So I put the sensitivity to aggressive, and the rest of it is set as it is, and I say OK. Now what this indicator will do is it will draw dots. Now the more dots in an area, the more fair value is located in that area. So if I was looking here, I'm just joining these dots with a straight line. So this is an area of fair value. And you can see that that fair value area was absolutely superb at picking that top. Now that worked because there was a large area of liquidity up here. And because you have liquidity and you have fair value, when the market then returns to that point, it's likely to reverse. And you can see that the point was touched here perfectly it was just exceeded there with a little spike, and the market came back and touched it again. That is the power of using liquidity and fair value. We can see here at this level that we've got liquidity and we've got fair value being generated here, and that acted as support for this market. You can see once we went through it, it was testing it from the other side and couldn't break through it. So now the question is, where is fair value here? And the answer is that fair value is at that point there. So for me to get excited about a reversal in this market, I would have to see the market trade above fair value, just as it did in this area here, pushes above fair value, comes back down and tests it, and that's the ideal setup for a buy trade. A sell trade is the converse. You want to see the market break down through fair value, only from an area of liquidity, and then come back and test that fair value from the underside. What you don't do is you don't anticipate a trend change. You simply wait for the market to show you what it's going to do. And you can see here, as we had liquidity, and if you'd had this indicator and you'd seen that 9,000 units of liquidity generated there, and you saw that the market started to generate fair value here, you could have had a fantastic trade when the market broke above fair value and then retested it from the other side. You could have done a buy trade at that point there. So this is how you use this indicator. Very, very important. You must have an area of liquidity. Pretty easy to see from the coloured candles down the day chart. Number two, you must have the generation of fair value. Now, forgive me for really going over this point, but I think it's extremely important that everyone understands exactly how to use this indicator. So let's look at this example here. So as this market was going up, you can see that fair value is being generated by the dots underneath the market that's moving up. And it's a good place to put your stops, are the fair value points. So you can see that we've got liquidity being generated, we've got more liquidity being generated, but what the market is not doing is it's not forming a fair value point. Fair value points are only formed when you have three dots in a line. So we've got 1, 2, 3. At this point here, you can simply draw a line. And what you're looking for is you're looking for the market to break down through fair value and retest fair value from the underside. This is one of the most successful ways of using this. So at that point there, you would have been selling this market. So once you've got a sell trade, what's the opposite of that? Well, it's a buy trade. And what does a buy trade look like? Well, we want to see the formation of liquidity. So as this market's coming down, we can see that we've got liquidity because color candles are being drawn. And at this point here, we've got the highest level of liquidity. And then we get 1, 2, 3 dots. And so we can draw a line. And whether you're trading on the day chart, the hour chart, or the 4-hour chart, it's always the same process. You must get the establishment of an area of fair value at a liquidity area, and then you can actually draw these lines. So when the market then broke above, you simply wait for the retest, and that's where you get in, is when it retests the fair value area. So let's go through it again on this one up here. You can see as this market came up, we get the establishment of fair value, 3 dots, and we can draw a line. So we know at that point there we've got liquidity and we have fair value. So once we break below fair value, and this is really where it breaks below, we want to sell the retest of the fair value. And you can see that if you'd missed that point, you could have got in there or you could have got in there, and they would have all been very, very good trades. Now, how far do you run these trades? Well, the target is just the opposite of what you would expect if you were doing a buy trade. As this market comes down, what you want is you want to see liquidity and you want to see the establishment of fair value. So 1, 2, 3. 3 dots of fair value would have me thinking to myself, if the market breaks above this, and which it did, and then retests it, I would put my exit at that point there. So you would have had the best part of, what was that, 4,902 points in that move there. Now, this is the way in which you trade this method. Why would you not be trading here? Well, the answer is you have no fair value. We can see, yes, we've got liquidity, but liquidity on its own is not enough to instigate a trade. What we have to see is we have to see at least 3 dots of fair value. So once I see that we've got 3 dots of fair value, we must break above the fair value. It's no good if you're below fair value just because you can see a fair value point. What we would have to see for a buy trade in the DAX is we would have to see a break above fair value. We've already got liquidity, but liquidity on its own is not enough to get you into a trade. You want to see the establishment of fair value. So using this indicator is extremely powerful. What you have to do is be patient, and you have to wait. And I would advise you using it on the daily chart, the 4-hourly chart, and the hourly chart, perhaps even going down to the 15-minute. But if you are trading, always pay attention to the higher time frame direction and the higher time frame liquidity. What you don't want to do is trade against the higher time frame liquidity. So we knew at this point here, when liquidity was falling and there was no more liquidity left at that point, we can see that the fair value was being established just here. So not only were we being warned, but we could see that price started to trade underneath fair value, which is always a bearish sign. So if the market at the top starts trading under fair value like it did here, you know that you should be looking for a sell. If it starts trading above fair value as it did here, you know you should be looking for a buy. At the moment on the daily chart, the DAX has not established fair value, so I would not be looking to take a long trade. But if we did, how high might this market go up? Let's have a look at the lower time frame to see if we can establish where the DAX might come back up to. So remember what we want to do. We want to mark liquidity levels at turns. So if I put the box in, you'll see these very clearly. So we've got this level up here. We've got this level just across here. And we've got this level here. And these all were turns, and they were all associated with fair value. So all I've done is I've put the lines on the fair value points. And what this means is it means that DAX could well return to this area where we could have a good sell trade. Consequently, we're looking, as this fall goes down, that if this market's going to turn around, what we should see is the establishment of fair value, and we should be looking for liquidity candles. Now we've only got 1 dot there on the hour chart, so until we see at least 3 dots, we can't say that we have fair value at this level. And also, if we wanted to get into a buy trade, we would have to see the DAX trade above our fair value level on the hour chart, and then it would have to come back and retest it from the upper side, and then we would get into a trade. Now, if it doesn't break fair value on the hourly chart, simply we're not interested in a trade. No matter how much we think there's liquidity, we are not trading against the market until the market proves to us that it's trading above our fair value. Never buy the market when it's trading below fair value. Always wait for it to break fair value and retest it from the other side. And similarly, for a sell trade, even if the market came up here, we wouldn't automatically sell at that level. What we would wait for is we would wait for the market to maybe touch that level, exceed it a bit, and then it will come back down through the level, and then it would retest it from the underside, and that's when we would take our sell trade. Very important that you don't try and jump the gun, and also very important that you're looking for liquidity, because liquidity is key, and the fair value is the point at which you pivot around to place your trade. Well, I hope you liked this video. Any questions, please give them to me in our Discord group. I'll put a link in below. You're welcome to like and subscribe to this video because I'll be making more interesting videos in the future. Well, thanks very much for watching, and if you want to get in contact, you can see our email address in the description below.